Hey folks, welcome to Quantsapp and welcome back to another video. So in this video, we are going to understand something really interesting. In this video, we are going to learn about a component that is the second largest component affecting our option premiums. So if you want to be a profitable option trader, you should watch this video till the very end. So in this video, we are going to understand about implied volatility. First, we will learn what is implied volatility. Then we will understand how implied volatility affects our option premiums. And most important of all, by the end, having all the knowledge of implied volatility, we will learn how do we apply this knowledge of implied volatility when we are actually trading in options. So do check out the video till the very end. So let's start this video by understanding what is implied volatility. Implied volatility shows markets forecast of a likely movement in a securities price. It shows us traders opinion of the stock's potential moves in the future. Okay, so what is implied volatility? Implied volatility is volatility that is implied by the price of the option right now. Okay, so it is showing us what the traders are expecting, how much volatility traders are expecting in a particular security in the future. Okay, how it is calculated? Implied volatility is calculated by option prices. So implied volatility shows us how much volatility there might be in the future, how much volatility traders are expecting to happen in the security in the future. How it is calculated? It is calculated using option prices. So now, if implied volatility high, then it tells us that traders are expecting instrument to be a bit volatile in the future. Okay, so they are expecting instrument to bit volatile to give big swings. If implied volatility is low, then option traders who are trading it, they're expecting the instrument not to give big swings. It might be a bit flat. So they are not expecting huge volatility to happen in the future. Implied volatility is traders' perception or traders' expectation of the volatility that might happen in a particular security in the future. Now, let's understand how implied volatility is important for us if we are trading in options. So let's understand it using Quantsapp's option chain what if analysis. Okay, so now this is option chain tool in our application, wherein you will get to see left hand side call options data, right hand side put options data, but I am going to option chain what if analysis. Okay, which means I want to understand what will happen if there is a particular scenario happening in the market. So let's try to understand it. Okay, so now again I am getting to see call options data on the left, and right hand side I am getting to see put options data. So now if you see the option which is quoting at 100 rupees, call option 18,150, and put option is quoting at 109 rupees. I am giving option chain what if analysis an input that how much these prices will be affected if implied volatility goes down by, let's say, 19%. The call option would be quoting somewhere around 80 rupees and put option will be quoting somewhere around 90 rupees. Similarly, let's say if I want to understand what will be the impact of implied volatility if the IV drops by 30% from the current level. So you see, my call option would be quoting around 69 rupees and my put option would be quoting around 78 rupees. So now let's keep it 0. Okay, let's hit the refresh button. So it will happen to be 0 every time. Now let's say if I'm expecting the IV to go up, just focus on call and put options. So let's say I'm expecting the IV to go up by 18%. My call option went up, my put option went up, right? Let's say if I'm expecting it to go up by 40%. See, my call option went up, my put option went up. Now what is this happening? So this is the IV effect on your option premiums. Okay, so that means that IV, if it goes up, it will take up your call premium as well as it will take up your put premium. Okay, so now let's say IV, it is correlated with your option premiums. Okay, so doesn't matter what happens in the market, if IV goes up, it takes up your call option and it takes up your put option, and if IV goes down, it takes down your call and it takes down your put. Now let's understand what impacts IV. Okay, what drives IV? Because let's say if I get to know I know that, okay, it is going to take down my call and put, it is going to take up my call and put option, and that too with a significant quantum. Now, if I get to know that IVs are going to go up, that would be lucrative for me as an option trader. If I get to know that IVs might collapse, that would be again lucrative for me for as an option trader. So let's understand what actually drives IV. So first of all, I would like to say IV is also called as risk indicator. Okay, it is also known as risk indicator, which gauges the risk in the market. Because what is IV? Traders' expectation of future volatility that might happen in the market. So if traders are uncertain about future, the IV will go up. If traders are certain about future, the IV will remain down. Okay. So now the important question is where you get IV. So you will get IV in option chain over here. For all the options, you will get to see what the current IV is for that option. Also, you will get to see the average IV, which is average of call and put. Okay, in the IV panel in Quantsapp. Okay, so over here you will get to see implied volatility, other implied volatility analytics like IVR and IVP, which we will discuss in completely different video. But as of now, let's understand one thing, that IV, whenever traders are expecting, if they are feeling risky about the market, okay, if they are feeling that the market might be a bit risky in the future, the IV might go up. Okay, so if I just show you one thing, so let me explain you this graph. The orange line is showing us the implied volatility, and the green color line is showing us the futures price. Okay, so typically IVs might share a negative relation with the underlying price. Okay, with the underlying price, which is the spot price. Typically, it might share a negative relationship because whenever risk in the market increases, market might collapse. Whenever risk in the market cools down, the market might increase. So if you see, IVs formed a bottom, orange line, if you see, it is bottomed out, markets moved up higher from there. IVs made a top, markets started to collapse. Okay, because the risk in the market, people were feeling very risky about the market, about the future of the market on this very day, and the IVs, the markets, they started to collapse. Even here as well, if you see, IVs are somewhere around the top, and it collapsed. If you want to see much more, I would say, if you want to see a larger data, then you can give inputs about the same. Let's say 800. So over here you will get to see, if you see, this is COVID spike. There was a lot of riskiness happening in the markets were risky, right? Everybody was fearful about the market. Risk was higher, IV went up, markets collapsed. So this is typically what the relationship it will share. Another thing is, whenever uncertainty in the market increases, the IVs increase, which means if the traders are uncertain about the future, the IVs will increase. So when in the market, typically there will be an uncertainty. First thing is events, any known event, something like RBI policy, credit policy announcement, budget, fiscal policy announcement, all these things, they will lead uncertainty in the market, they will create uncertainty in the market, and which will lead to increase in implied volatility. Simple. Second thing is stock results. Typically, you will see that whenever stock announces its result, IVs, they start to go up before the result, because in the future there is uncertainty in the market, and once the results are out, once the uncertainty becomes known, IVs collapse. So this is Infosys. Just look at this circles, the black circles on the graph, those are showing you results, that on those days results were announced of Infosys. Just look at it. Before the results, IVs starts to spike up, because there is uncertainty in the market, uncertainty in minds of traders, it increases. But once the result is out, there is no uncertainty, the IVs might collapse. And one last thing you should also understand about IVs, that just look at this chart. Okay, just look at this chart, which is of Infosys implied volatility. Or let's increase the data. So if you see, IVs, they are not sustaining at upper or lower level, right? If the IVs have spiked up, they collapse, they come to its normal regime. If they are at bottom, they spike up. So typically you will see that IVs, they have a mean reverting characteristics, means that it will not sustain at higher extreme for a lot of time, and neither they will sustain at lower extreme for a lot of time. So now what we need to do, what our trade is? So the trade is, if the IVs are at bottom, we prefer buying options. Okay, direction is something which is you can predict using any other indicator. But if IVs are at bottom, now how will you identify if the IVs are at bottom? You just need to look at IV chart over here. If you see, okay, the orange line, if it is around its bottom, it means that IVs have bottomed out. If you see that they are in its upper regime, which means IVs are at top. So what would be the strategy? So first strategy would be, if they are at bottom, you prefer buying options. Okay, direction is completely your call. If you are feeling bullish on the instrument, you will preferably buy a call option, and if you are bearish on the instrument, you will preferably buy a put option. Okay, you will not convert, you will not sell options when the IVs are lower, because you are expecting IVs to spike up, and it will jump up your call and put premium both. Similarly, if the IVs are on the upper extreme, you will look an opportunity to sell options. But if you are having any direction, let's say you are planning to take a directional trade, you can convert these things into spread. Matlab, let's say if IVs are at this point and you want to take a bearish trade over here, you can convert a long put into bear put spread, so that you don't lose out a lot on IVs. Okay, so that is the two strategies what you can do. Very simple strategies. You can create it in option architect. Another strategy is, let's say you know that any stock is going to announce its result. Okay, then you know that there is IV spike which might happen, correct? So how will you do it? So you know that IVs will spike up. So let's take an example of Reliance. That, let's say Reliance is going to announce its result. So you are buying call option and you are buying put option. Okay, and just leave it over here. So you see a long straddle. So this is called as long straddle. So what is benefit of this strategy? You will not face undefined loss. Plus, just focus on this. Okay, so I'm giving inputs that the IV might go up by 12%. See, the curve is, it has shifted. The black dotted line is showing us T plus and PNL. So you see, at the same level, you are making a profit of 2144, even if IV goes up by 12%. So in this strategy, you don't need to predict any direction, market going anywhere. You will still end up making money. So this thing you will do before the results, right? Before any major event, when the IVs are spiking up, so that you get call and put premium benefit over here. So the IVs which are spiking up, it will give you call and put premium benefit. Second thing is, you can create hedge strategies. Okay, you can create hedge strategies if you want to actually sell post the result, post any event. Because let's say if you want to benefit from the IVs collapsing, so you can create condors. So you can do it from the architect tool directly, or you can build yourself own strategy. Okay, so this is T plus and PNL. So let's say if the IVs even collapse by 15%, okay, you see the payoff graph, it has shifted in our favor. It is giving us a profit. So you need to go ahead with an hedge one, okay, because shorting volatility is something which comes with undefined risk. So to summarize what we learned, so we learned what is implied volatility, then we learned how it impacts our option premium. So it is positively related with our call and put option both. Third thing we understood is IVs, they spike up before any major event. If there is risk happening if the participants are feeling risky about the market, the IV spike up. And then we learned about strategies. So 4 strategies that we learned is, if the IVs are at bottom, you will prefer buying options. If IVs are at top, you will convert directional trades into spreads, and you can look up opportunity to sell options over there. And before results, you can consider long straddle, but don't hold it for a lot of time, because time might go against you. And lastly, after results, you should ideally go ahead with hedge strategies. Okay, a hedge strategy. On short side, you should go ahead with hedge strategy. Something like condors will be beneficial. Yes, folks, that was it from my side for today's video. Thank you so much for joining me up till here. If you have liked it, do with the like button, do with the subscribe button, so learning content reaches you first. Thank you, and be a data driven trader with Quantsapp.